Good evening, one and all present here. I am Dr.V.Deepha from the Department of Business Administration PG, Dr. S.N.S.R.C.A.S College of Arts and Science. Today we are going to discuss about the Unit 2, Sources of Finance in the Financial Management. Under Source of Finance, we have the long-term finance and short-term finance. Long-term finance, it refers to raise funds for the period exceeding more than 1 year. So typically used for major investment, expansion or strategic project. It includes the instrument like equity bonds, long-term loans and leases, etc. So long-term finance involving borrowing or investment with a maturity period for more than 1 year. It covers both debt investment and also the equity investment. Example for debt investment, it comes under the bank loans, debentures and bonds, lease, etc. Equity investment comes under the shares and venture capital, trade credit, like that. So what are the features comes under this? Maturity period, stability, risk and return, capital structure, impact. So source of long-term finance. Ordinary shares. Ordinary shares is also known as equity shares. Equity shareholders is the real owners. They enjoy the rights and also they have the voting power. Okay. So ordinary shares are equity instruments that represents ownership in the company. Holders of ordinary shares have voting rights, may receive dividends and have a residual claim to the company asset after all liabilities, and preferred shareholders are paid in the event of liquidation. Ordinary shares are the fundamental form of equity ownership in a company and represents the holder's residual interest in the firm asset after all external liabilities and preferably claims have been settled. So ordinary shareholders have a proportionate share of the company profit distributed in the form of dividend. So in the event of liquidation, ordinary shareholders have the residual claim. They paid only after the creditors and holders of preferred shares have been fully satisfied. This comes under the ordinary shares. Next, right issue of equity shares, preferred shares and debentures. The right issue of equity shares is an invitation of existing shareholders to purchase additional equity shares in proportion to their current holdings. So offer only the existing shareholders, usually priced lower than the market price to encourage the participation, help companies raising funds of expansion, debt repayment or working capital. Shareholders can either subscribe to the new shares, re-announce their rights, ignore the offer. Under the right issue of preference shares, the company offers the existing shareholders on opportunities to subscribe the new preference shares. The offer is made in proportion to their existing holding. So, under the key factors of the existing shareholders, usually they offer for the existing shareholders, then usually at the low price, priority in dividend, capital raising alternatives. So, issue of debentures, what is a right issue? The right issue means a company gives existing shareholders the right to subscribe a new security before they are offered to others. Right issue to debentures. A right issue to debentures, a company offers debentures to their existing shareholders in a fixed ratio, usually a dividend interest rate and repayment period. Debentures equal to long-term borrowings issued by the company. So why company issue debentures by rights? To raise funds without diluting ownership, to avoid bank loans, to leverage debt tax benefits. So under the key factors of right issue debentures, offer existing shareholders fixed rate interest, repayment terms, secured or unsecured. Term loan. A term loan is a debt facility provided by a company or financial institution for a specific period with a defined repayment schedule. So it may be include a companies or individuals borrow money for capital expenditure, project finance, working capital investment or purchase of an asset. So under this, principal, tenure, interest rate, repayment schedule, security, conventions and purpose. So next one, asset based financing under hire purchase, lease, so many things is there. So under the asset-based finance, in hire purchase, it is a form of the financing where buyer obtain the possession and use of an asset by paying an initial deposit. So in simple words, you can use the asset now and pay gradually. You become the owner only after the last payment. Next, hire purchase in the form of asset financing. Use the asset and gradually you can use after the ownership, after the last payment you are getting that. So leasing, it is a property rental agreement defining the relationship between the leaser and the leasing. So here binding contract outline the condition under the one party agree to rent the property of another. So they have exchanged the lease is guaranteed access to the property while the leaser receive regular payment of the specific duration. These are the ways. Next we see the venture capital financing. And the venture capital financing is a type of private equity investment specific to the early stage business that require capital. The venture capital firms have a variety of different securities they use depending on the nature of investment. The most common security are convertible debentures. The kind of instruments that investors uses depend on the variety of factors related to the company, the investors, and the risk will be owned. Venture capital. So these are the 4 stages: seed, early, formative, later. Short term finance. இதுக்கு முன்னாடி நம்ம பார்த்தது எல்லாமே comes under long term. Now we are going to see about the short term finance. Under short term finance, you are getting the funds only the short period, less than 1 year. It is support for the daily operations, managing cash flow, or handle immediate needs. So short term finance comes under the trade credit, bank overdraft, and commercial paper. So under the short-term finance, pay suppliers and wages, maintain inventory, cover operational expenses, deal with seasonal demand, which temporary cash shortages, fund short-term projects or emergency. Trade credit. Trade credit is to business, B2B agreement. If the customer can purchase goods without paying cash, unfreight and pay the supplier to the later. So first they are purchasing those, after the payment will be made for the later. So B2B business. Usually business that operate the trade credit will give buyer 30, 60 or 90 days to pay. Next, bank credit. Bank credit is to the total funds available for borrowing from banks, encompassing loan and credit lines of individuals and business. This credit is privately buying homes, cars and for the business operations. So the bank will be dependent upon the ability to repay by loans. Bank credit is total amount of funds that individual or business can borrow from the financial institution. Bill discount is a short-term financing service when the business sells its unpaid invoice to a bank or financial institution for immediate cash or discount. Next, commercial paper. It is a short-term debt instrument issued by the corporation and financial institutions to finance short-term liabilities like working capital. So it is sold promissory note at the discount and face value with investor encouraging the difference upon the maturity made than 7 days and the 1 year. So commercial paper is a form of unsecured. It is commonly used by companies to finance their payrolls and payable. Maturity on commercial paper range from the 270 days, average of 30 days, 1 month. Commercial paper is issued for the discount and measured in face value, real value. The minimum amount of commercial pay is 1 lakh and it pay fixed rate of interest that fluctuation with the market. Thank you.